being completely naive, I just took $3,000 I had, put it into a trading account, and I thought, well, what's hot right now? And at the time, it was lithium batteries, lithium for electronic vehicles. In 7 days, I kid you not, that stock had shot up $1,500, and I sold it. And I remember the moment I'm like, 7 days, and I've almost 50% of value to my portfolio. Like, this is going to be like shooting fish in the barrel. I got to this point, Ari, where I'm like, this is not like an engine. This is not doing what I need this to do, maybe one day fund retirement or give me passive income or anything. I was surrounded by people that had second incomes. I only had one. Long story short, my research ended up leading me towards ETFs, which I like. I know they're very controversial. Believe me, I've seen a lot of videos. I primarily have those dreaded covered calls. Sounds like it's a 4-letter word to some people out there, especially in the growth community.
Welcome back to Masters of the Market. This week, I am thrilled to have on with me Matt Blom, who recently just emailed me as a newer investor, but actually upon hearing his story, I had to bring him on. His portfolio is small but mighty right now, but it is growing. So Matt, welcome to Masters of the Market. I want to go ahead and toss you the first question right out of the cage here. What exactly is your story? How'd you get to where you are today?
My story's kind of, I guess to me, it feels like it's not really typical for the investors that I see out there. There's so many comments when I look at investment videos, and you've got someone who comments is like, yeah, I put 100K into this and, move 50K around, and hopefully by the time I turn 21 years old, I'll have $1 million. And, I'm a guy like me. I'll explain in my story, unfortunately, due to life circumstances, I kind of had to start investing a little bit older. And, a couple things inspired me to reach out to you. First of all, in so many of these videos and interviews, which are great that, yourself and others do, yeah, you get so many investors that are already mega successful. And it's great to hear those stories, but when you're just starting out, it can honestly feel like a little deflating and depressing. Like, how do I get from here to here, which is what you're seeing in the investment world? And the other thing is, I'm pretty self-depreciating, and so, just for fun. And so, I hope that people laugh at me and cringe at how bad I was starting out with this. My hope is that through the lessons that I've learned investing, that maybe if there's even just one or two new retail investors out there that see this video that can laugh at me and be like, okay, Matt did this, but I'm not going to do this. I just had a good joke on his behalf. Let's get my portfolio kick-started in the right way. So I think my story really starts, I'm Canadian, but my lineage is Dutch and German. And those people traditionally, stereotypically, are very frugal with money. And so I was raised a couple ways. Number one, you have to hate debt. Debt is the enemy of all, and is the number one financial priority is to make sure you don't have debt and pay for everything yourself. That comes from my German mother primarily. The other thing was, save, not invest, just save. Just put every last dollar in a low income savings account. Just put money away, Matt. And that just doesn't work in 2025 with cost of living and everything like that, obviously. But unfortunately, that had some issues when I was a younger guy. I just turned 40 now. But when I was young, I wanted to take 2 university programs. So I wanted to get a bachelor's degree. I got one in psychology. And then I wanted a certificate of marketing and sales from another university. Now, I was eligible for student loans. I could have taken them. In fact, I was about a couple clicks away from getting approved and getting a student loan. But I had been raised to hate debt so much of any sort. There was this weird kind of youthful stubbornness where it's just like, no, I'm going to pay for all my university myself, no matter how long it takes. My parents had a very small college fund for me. It basically covered books for 2 semesters a year. But I was on the hook for everything else. I could live at home for free, but I actually had to buy my own groceries, pay my own gas, car insurance, everything like that. Things were very tight. Long story short, because of those 2 programs, I graduated at 27 years old from the second program, struggled to find a full-time job in my field for about 9 months. Did end up finding a job with a great company, a company I still work with to this day. However, I then, when I moved out, which was quite late, my late 20s, I had to obviously set myself up by every single thing to set myself up. I was not in a position, honestly, where I could invest until my mid-30s, which was depressing because I wanted to do it. I regret that, but I can't really blame myself for that. But what I can blame myself for is my mistakes when I first got into investing, because what ended up happening was I didn't do much research, and I got into it right during the pandemic where everything was frothy. Being completely naive, I just took $3,000 I had, hanging around. I put it into a trading account, and I thought, well, what's hot right now? And at the time, it was lithium batteries, lithium for, electronic vehicles. Governments were putting in stimulus, for that industry. And so I just found a lithium mining company I liked. I threw all $3,000 at it, no diversification. The stock market was so frothy that in 7 days, I kid you not, that stock, I forget what ticker it was, shot up $1,500 in valuation, and I sold it. And I remember the moment I'm like, 7 days, and I've almost, I've added 50% of value to my portfolio. Like, this is going to be like shooting fish in the barrel. Number one lesson I had to learn starting out was don't be arrogant with kind of beginner success, especially in a frothy market. Feel free to roast me in the comments, people, because I know how stupid these decisions were in retrospect. I then split that 4,500 between two stocks, okay? I knew nothing about ETFs at this time. So one of the stocks was Peloton, the darling of the pandemic, all those indoor subscription-based athletic machine. I bought the stock when it was very high because I had a friend, and he's honestly very good at investing, and he's done very well for himself. But he thought Peloton was ripe for a takeover by a big tech company like Apple or Google, and that just made a lot of sense to me. Now, unfortunately, this is where my luck really turned, because with that stock, about a week after I bought it was when the first reports came out that the equipment was harming pets and children potentially. There were reports, and that stock just plummeted like 90%, and it never recovered. And that was really my first big hit. And again, lack of diversification, perhaps bad luck on that one, but I did know I was buying high and taking a risk, which is not something I would do again. The second stock was much more my fault. It was for a biotech company called Aquilium. This is the cringy part. I got that stock tip off from yahoo.com. I know. We're here. This is the entertainment part of entertainment in education, but, and I'll say this is my lesson, but please, if you're out there, a new retail investor, do not, think that a website like Yahoo is going to have a hot stock to suggest for you. It's something that, some writers thought of, or they might even be sponsored for it. Anyways, Aquilium was a one-trick pony. They had one drug that was nearing FDA consideration. And guess what? It failed to be approved. The whole company just collapsed. All they did is blame the FDA for, well, our drug should have had more efficiency. It did after 60 days, but FDA rules are like 35 days. Whatever. For an investor like me, it just meant that, it plummeted. That was my most depressing moment of investing. I'd gone from this quick start to this collapse. And I basically lost everything I made on that first trade. And I did what I shouldn't do. I should have probably got up and dusted myself off and thrown some more money in and done my research. But honestly, I just got so depressed with investing at that point, I stepped away from it for a couple of years. We had that major correction, I think, in 2022. It might have been late 2021. Anyways, and I was done. And so picked it up a little bit in 2023, started to learn about diversifying, picking some people's brains that I knew. But it was no ETFs, it was no income. Some of my decent picks were, I had Disney and I had a company called Datadog. Datadog went up about 60% when I sold it. Disney, I had modest means or desires for that one. I just hoped it would bump up 20%. It was trading lower than it historically did. So I did actually score, 60%, 20% on the Disney, but I got to this point, Ari, where I'm like, this is not like an engine. This is not doing what I need this to do to maybe one day fund retirement or give me passive income or anything. Like trading stocks making $1,000 here and there, that's just not going to get it done. Again, I was turning 40. It's a big milestone. I decided I got to get myself in order here. So I did a ton of research, ton of YouTube videos. It's where I found your channel and tried to come up with an investment solution that worked for me. The goal that I came up with is I was surrounded by people that had second incomes, whether it was through side hustles or most cases they were married or in a long-term relationship and living with someone where they could combine two incomes. I only had one, and I don't work in the public sector. I don't have a pension either. So what I wanted to do was just create a second income stream. But I didn't want to be risky with it and flush everything down the toilet like I did with my first gains. So long story short, my research ended up leading me towards ETFs, which I like. I know they're very controversial. Believe me, I've seen a lot of videos. I primarily have those dreaded covered calls. Sounds like it's a 4-letter word to some people out there, especially in the growth community elements there. But I basically came up with a strategy. I know it's based on a fairy tale or whatever. I just call it the Goldilocks strategy, which is, if you remember that fairy tale, or it's the hot porridge and the porridge that's too cold and the porridge that's just right. So I essentially split my investments between, 30% high risk, 30% medium risk, 30% low risk, as I consider it. Yeah, so my higher risk holding is NEOS, their Bitcoin fund. Very volatile, but the income is great from that. The middle one is my Superstar, also by NEOS. That thing won Best New ETF of 2024. I think it was, by one publication. And then the lower risk one, which is based on the S&P 500, it had a little bit of trouble with the recent U.S. jobs report. It started to climb its way back up. Small trading accounts, right now it's only about $15K, but it is generating a little over $300 a month in income, which I'm almost exclusively dripping. So I do expect that to grow, and I did get a change to my job that got me a pay bump about 7-8 months ago, and that's allowing me to throw a lot more money at my portfolio than I could in years past. So I'm excited about doing that as well, like not just dripping it, but being able to, I hope to throw about $15K every year at this portfolio. One last thing I'll say before I'll let you ask some questions that you might have. We have this amazing thing in Canada. Are you Canadian, Ari? I'm not sure.
No, I'm not Canadian, but I had a lot of Canadians on.
Okay. Well, we've got this amazing thing up here. Canada's got a lot of problems, but one of the top 3 things about being Canadian might be hockey, maple syrup, and the tax-free savings account. TFSA, I don't hear this being spoken a lot of down in the US, because this account that we have that the Canadian government gives us is absolutely amazing. I think the closest thing you could think about or compare it to is a Roth IRA with almost no restrictions about withdrawal. The only restriction is that we only get about $6,000 to $7,000 per year we're allowed to throw into this TFSA. And so it stands for tax-free savings account, but most people use it as a trading account. And any and all gains, both dividends and capital gains in that account, are completely tax-free. They can be withdrawn at any time. And when you withdraw from your TFSA, the government actually gives you that space back. So if I were able to, say I had $5,000 worth of my TFSA left, if I throw in $5,000, grow it to $15K, take $5,000 back out, the government's going to consider, oh, he took $5,000 out of his TFSA, he gets more space to put more money back in. It really is it's a game changer for Canadians. And I do think it makes investing very good up here if you can get involved there. So yeah, as far as my initial story, that's what I've got.
I would say first and foremost, I have been hearing a lot about this Canadian TFSA, and I gotta say, if there was one thing, a ticker move that would make me jump up to Canada and move there, it's that. I could do away with the hockey, maple syrup I love, but that savings plan is out of this world. Every time I hear about it, I'm blown away. Matt, I got a question about your story. You've had some trials and tribulations. We spoke a little bit even just before I hit record, and then you shared it again where, you had been investing, you hit, some brick walls, so to speak, and then you stopped. But then you ultimately did get back on the horse. Now, a lot of investors wouldn't. I mean, they might stray away for a while and then still have that hesitancy, but you actually came back in and kind of went full force into this ETF direction. So what was it that gave you that comfortability to get back in the game, knowing that ETFs were going to be kind of the it strategy for you?
What I would actually say is that uncomfortability got me back in the game in a couple ways. Number one, I just really didn't have many other options to grow wealth other than through the market. And I just think that's, a function of very high cost of living, housing prices, which are one of the traditional investments. I basically knew I had to do something. Now, in addition to that, my brother is a pretty successful but also aggressive growth investor. And there were a lot of texts and comments at, family dinner saying, why aren't you getting back on the horse doing investing? You got to grow your wealth. I would say if there was a comfortability factor, it would be my friend, the same guy that tipped me off on Peloton. Again, I'm not blaming him at all, but he was getting so successful to the point that he was starting to talk about early retirement. And I'm talking not freedom 55, but freedom 45. He has, I would say, higher income needs than I do. He does have a family, but I mean, they go on, some pretty lavish vacations and stuff like that. And he still would be able to afford this just through trades and income and dividends. It was that combination of me needing to do something, as well as some pressure from, like I said, friends and family, and ultimately just seeing the success of a few people around me that kind of put a little carrot in front of me, you got to get back on doing this. So yeah, the market I think was starting to pick up a little bit in 2023 as well. And I didn't know I was going into a holding pattern when I went into it, bought that Disney and Datadog, as I mentioned. I knew I was going to do something else at some point, but I was just not educated enough yet to think of anything besides, I just want a few growth stocks and blue chips.
What do you think helped you along the way in terms of comfortability or calming the nerves? Because, I mean, you had quite an experience. And again, I just speak to a lot of investors where there's this moment sometimes that they back away from the market because something happened. Something always seems to bring them back in. And I know there's probably investors out there right now who are at that very moment. Well, should I get back in? Should I not? Is this my thing? So what was it for you that actually gave you that comfortability?
You know what? I was one of those people that really, and I think a lot of new investors get this, where the market drops 3% a day, or, for a few days in a row, and you think the sky's absolutely falling. And fortunately, my friend, again, I'm referring to this guy who gave the Peloton tip. He was very comforting with me. He was just like, Matt, settle down. The market goes through these phases. So that brought some comfort to me. If I didn't have him, I probably would have made some worse decisions early on and, sold when I shouldn't, panicked when I shouldn't. And maybe that's a lesson in itself for newer retail investors out there. Try to find someone more experienced. You told me I'm one of the few people that's not on Blossom yet. Again, it's because I'm so new at this. I've heard of Blossom. I'm sure I'm going to jump on at some point. But if you're a newer investor, try to find a mentor. Try to find someone that you trust that is in the market and can be an emotional lifeline for you and give you that comfortability that you're talking about by calming you down when the market hits both phases, right? You need someone to calm you down when the market goes lower. You also need someone to calm you down when the market's skyrocketing, telling you, don't spend all your money to buy when the market's at its highest. Wait for a little, dip perhaps. Mind you, I like a few of Warren Buffett's quotes. And of course, one of them, he says, it's not timing the market, it's time in the market. That's a little bit of a regret of mine. I think it was good for my mental and emotional health to take that year and a half, 2 years off of investing, essentially. Nowadays, with the confidence I have, I do have some regrets that I didn't spend more time in the market. Just find VU, find some index-based ETF, throw 15K at that, 3 years ago, and then make the decisions I'm making now. That would have been a much better play for me in retrospect. But maybe there's a lesson in there itself for retail investors. everyone is going to make mistakes. I know the comment sections are filled with, hey, I just transferred 500,000 here and 100,000 there, and I hope by the age of 21, I'm going to have this $5 million in my trading account. I'm not saying those comments are from people that are lying, but you have to understand, just starting out, you can't get depressed that you don't have a lot of capital. You can't get depressed that if you're building an income engine like I am, that it grows slowly. You just kind of have to stick to it. I'm just trying to think of something else. You just have to stick to it and do it. And if your education is good and the fundamentals are there for the funds or the stocks that you're investing in, you'll do well, especially if you can hold through a correction. If the fundamentals for these companies or these funds are there, you're going to recover. And I think we saw that, for the most part, a lot of us saw that after the April Liberation Day when things climbed back up. So it's kind of a long-winded answer to that, but hopefully it helps a little bit.
It's funny because you are kind of a self-proclaimed new investor, but you sound like a well-spoken, experienced investor, if I don't say so myself. And you've been now invested for how long?
So I would this current form of investing is just since January of 2025. I essentially, thank you for your comments about me being a seasoned investor. I would call myself an intermediate investor now. I think there's things I could do in the future, such as more individual stocks, puts, calls, that sort of thing, which I don't do now. And because I don't have the knowledge to do that now, I can't. And I don't want to have the arrogance of calling myself an expert, but intermediate perhaps. So yeah, this current strategy since January of 2025, when I decided to do this about mid 2024, I basically gave myself the rest of the year to educate the heck out of myself. So I was reading every website I could, so much YouTube. Like I said, that's where I found your channels and so many others. And I was just like, I wanted to take the time to do it right. And approximately 6 months felt like it was a good amount of time to do the research. And sure enough, by the time I hit January 2025, my official start point that I set for myself, just sold everything that didn't fit my current portfolio and assembled this Goldilocks model, as I call it, built out of ETFs. It was kind of just like okay, ready, go. Everything was set, the education was done. But there's a lot more to get educated about. I do want to move into growth a little bit more in the future. I don't want to be all income all the time. This distribution or dividend engine, whatever you want to call it, I only plan on building this a few years until I have that relatively reliable monthly income stream. I'd say about $1,500 a month is where I would like to get to. I should add, one thing I did consider when I was looking at strategies was to just go all in on the indexes. But another deflating thing is you look up the big indexes, it's like $550 per stock. And I know you can go fractional and whatnot, but my specific trading brokerage that I use doesn't actually have a fractional option for stocks or funds. So if I wanted VU, I'd be spending, with the exchange rate, $700 Canadian for one stock of VU. It didn't seem like a way that I really wanted to invest, just save, some money to buy a single stock in a fund. So yeah, so that kind of changed my mind and orientated me along this path as well. But yeah, to answer your question again, I'm being long-winded here. 7 months, and I had modest goals. I thought at first if I could get to about $120, $150 in distributions by the end of December 2025, I would be happy. But like I said, I just crossed the $300 mark, and things are going well. The ETFs are growing as well as, producing that income. So yeah, I'm happy where things are going. My revised goal now is that about $500 of income per month in December. And again, I'm just going to tease you American viewers. It's just so amazing, the flexibility of this TFSA. I plan to treat myself with a little staycation, and I can, if I want, just rip, that $500 right out of that fund, go on a vacation. And not only is it completely 100% tax-free when I rip those distributions up here, it gives me that additional $500 because the government goes, he took his $500 out of his TFSA, he gets $500 more room to invest. So Yeah, that's when I'm really rolling. When I do treat myself and pull that first 500. Not going to do this often. I'll be dripping 98% of the time, but maybe there's a lesson in there itself. I do think for a newer investor, you have to find some sort of way to reward success, your own success, even if it's small, because we're human beings. Motivation is something. Again, I have a social psychology degree. I've studied motivation to a degree. You can't just like, oh, I'm going to throw this money in this account and look at these digital numbers for the next 30 years. And then when I'm a senior citizen, I'm going to pull all this money out and retire. Yay. Like, honestly, maybe that's motivating for some people who are really good with a long-term deferred gratification mindset. But I think most humans need little bits of dopamine and reward here and there. And so, yeah, that if you're a growth investor and you're doing well, and say you're new, you've had a year and you're doing well, maybe consider selling a couple stocks and going on a vacation or whatever. Buy yourself a nice bottle of wine if that's your thing, or some collectible you've thought of. And don't do that all the time, but I do think like little bits of reward are important when you're an investor.
I absolutely agree, and that's something I guilt myself of earlier on, because I spent so much time money in the market, money in the market, money in the market, and it's like a blink of an eye, and all of a sudden you realize, you know what, I would have been just fine if I celebrated a little bit some of these victories, which is something I'm actually doing now more than ever. But something that you shared that I thought was incredibly important, and just so everyone knows. Again, Matt's portfolio is $15,000 roughly, and he's bringing in now, as you shared, a little over $300 a month, and he started in January, which just goes to show that these funds really do accelerate that income pretty rapidly. I want to ask you, in your experience and your opinion, is this where every investor should be starting, younger investors, older investors, or is there room for investors to go more for growth? I know you're 40, so what's it like for you when you look at some of these younger guys out there, their 20s? Is this also the approach that they should be strategizing with?
Here's where I'm going to get on my soapbox a little bit about trying to protect newer investors from some bullying that's out there. I'll be quite honest. I'll use that term, bullying. I think I'll start by answering your question. I'm someone that honestly thinks there is no one good way to invest. There are a million permutations, if not more, on how you can invest. I was inspired partially to email you and to try to get on the show because I saw how Rabid Mongoose, aka Jamie, on one of your videos a few videos ago, was getting dogpiled by some people in your comments section for his high income chasing yield approach. And I just thought it was showing a profound lack of self-awareness from that element of growth investors. I call them the growth bros. It seems like crypto's lost some luster, NFTs have lost some luster. So it seems like those same kind of people moved into growth investing, and for whatever reason, they only want to growth invest, but they go to all the videos for income investors and just rip on them in the comments, which I don't know why. I certainly don't have time in my own life to look up growth investing videos and go to the comment sections and be like, no, you need to be an income investor because that is what I do. And, you're missing out on, 2.5% of the market compared to whatever ETF you're in or something like that. Who cares? You look at the case of Jamie. What did he want to do? He wanted to reduce his debt and I think pay off his house. His strategy, could he retire on that? Is that a safe strategy for 25, 30 years from now? Who knows? Maybe not. But his investment strategy did what his own goal was. I don't get why people project their own investment goals onto other investors. I'll give you an example here. Myself and my friends are planning, my close buddies, we're planning to do a big trip to Vegas in a few years. You don't have to be just a long-term buy and hold investor. At the end of the day, we're in a market that allows us to make money in several different methods. What type of money, whether it's income or long-term growth, what we do with that money is up to the investor. So I just don't understand how you have these investors that are totally meeting what their goals are, but because their goals are not the classic 25-year buy and hold, you get this group of investors, this subsection that just rips on them. So to newer investors, you've got to tune out that noise. You've got to define, probably your starting point is define what is your goal. If your goal is to make, $5 million on a 30-year buy and hold portfolio, that's fantastic. You have that goal, figure out how to get there. But if you have that goal of you just want to throw stuff at ultra high yield so that you can pay for a mega trip in 3 years, that's fine. And don't let anyone tell you that you're a dumb, uninformed investor who's losing money. You're going to make your goal. And that's all that should count for you. I think there's an element of greed here too, Ari, or maybe I should say competitiveness. There are people that if they don't maximize in their mind every percent that they can wring out of the market with an investment strategy, they're not going to be satisfied. And those types of people will often use the term losing money. A guy like myself, if I get 15% year over year gains in the market, I'm just pulling that number out of nowhere. That's not my number. But a growth investor gets 17.5% in their portfolio compared to my 15. I don't care. Because guess what? We're both up. I'm up 15%. You're up 17.5. Can't we just, hold hands, sing Kumbaya, or grab a beer together or something? I'm sorry to the growth investors out there. If you point out, well, you could have been 2.5% more up and run this through a calculator, what you could do the next 30 years. I don't care. I'm still happy with where my investments are going. They're paying for what I need. Yes, my covered calls, those dreaded covered calls, they do, cut the tail off the dog a little bit to feed it with, balancing income, but there still is some upside growth. And you go to people, yeah, but it's capped. Who cares? And for the most part, I would say, between 60 to 75% of the market when it goes up. And, they're going to say the same thing when it crashes. Well, you know what? I can afford lower distributions and the 2 to 5 years for those funds, if they do crash, to get back up. In my mind, it's the right strategy, and I don't care who comes at me for this. But, newer investors out there, please just don't listen to aggressive people in comment sections or on Blossom based off your financial strategy. If it works for you, stick with it. Enjoy your success. Tune out the noise.
I think it's a message every investor needs to, first of all, just really sit down and take in. Even the investors who are out there, I'm running a dividend investment channel, and over the years, my strategy has been adapting, remolded, changed, and man, in the comments, I was like, wow, this is a great move for me, right? And all of a sudden, you get comments that are like, what are you doing? Why that? Why this? But like you said, it's at the end of the day, you're winning, and that's all that really matters. So this all kind of sounds like it comes down to an investor profile, which is, I think, to me at least, very clear that you have your investor profile set in stone, at least for where you are at today. And you're really well thought out in regards to your own investor profile. So how do we get to that reasoning for ourselves, how we should be investing, our goals? Like what do we throw on the map for ourselves to make sure that we have the correct profile?
Well, obviously, like I said, you want to know what your goal is. Like, where do you want to end up with whatever type of investing you're going to do? So when you define your goal and you have your plan, you then have to figure out a way to measure it. Measure success as you go along the way. I'll refer to my story. I had what turned out to be a modest goal of between $120, $150 per month income by the end of my first year. Now, I ended up smashing through that goal, but I told you now I have a new goal, which is, about $500 income per month. So you do have to look at your portfolio as you go through. Like, you have to make sure that as you're running this marathon, that you're keeping up with your checkpoints, with your times to get to where you're going. So yeah, that's probably the best way that I can answer that. I'm trying to think if I've got, any other tips along the way. I guess I would say, like, if you do notice things are going wrong, you have to be patient, but to a degree. I mean, I go back to Alti. I bought Alti when it was at like the $6.10 per share range. But, and maybe this isn't the greatest example, but it's the one that's most in my mind. When Alti started, like that thing was much higher valuation, and it just tanked, and it tanked and tanked and tanked until they changed the prospectus, I believe March of this year. And for those initial investors who watched months of tanking, you know, you do have to get to a breaking point where you need to cut your losses. I think one thing about my early story that I maybe should have emphasized a little bit more was kind of that stagnant period of 2023 to 2025 where I didn't have much growth going on at all. I was wasting years with a strategy that was really stagnant. Again, I'll just use that term. I should have cut my losses, but there was a stubbornness to me that was like, well, I don't want to lose any more money in this market. I had these two stocks that crashed. I'm just not going to sell no matter what. And you have to be more flexible, Ari, just like what you're saying with your own portfolio. You have to be flexible. And it's hard because there's no specific point. Like I can't tell someone, oh, if a stock or a fund goes down for 3 days in a row, sell it. Like you can't give any sort of definitive advice like that. But you've used the term comfortability a few times in this video. I would say, how does a newer investor know that they're on the right track? Number one, they've got their goal. Number two, they've got a way to measure it as you're heading towards the goal. But number three, you can just sleep soundly at night knowing where your money is. I mean, for me, I've never been a min-maxer. I've never been someone that tries to maximize the parts of life, my skills where I'm good, and minimize where I'm bad. I've always wanted to be a jack of all trades since I was a little kid. I just wanted to be good in most areas, and I think my portfolio reflects that. And that's why I can sleep soundly at night. Again, Goldilocks, like a near perfect split between high, medium, and lower risk ETFs. And for me, as someone who prides that jack of all trades mentality, that just suits me. That gives me that comfortability to sleep soundly at night. So yeah, as a newer investor, you want to get to that point where you're seeing success, you can sleep soundly. Maybe that's an oversimplification, but that's how I would think you've got a pretty good portfolio going.
Now, Matt, just moments ago, you mentioned that you were going to be adding eventually some growth back into the portfolio. So I'd love to know how you're going to go about that, and what's I don't know if it's the right term to say like the proper amount in which is going to give you that green light to do that. But how do you know when it's acceptable to then start adding growth?
Well, I mentioned earlier my goal for the first few years with this dividend/distribution engine was to get to be about $1,500 a month. And why I picked that number is that would be approximately 2 or 3 VU or QQQ, those big expensive index funds. I'll be honest, there's some flexibility here. I'm still picking between the different goals, but right now I would plan to drip that income, but drip it between the large indexes. I know they're boring, but they're safe and they do grow, and I do want to retire one day as well. And then I would think I actually want to get into some precious metal companies, whether it's stocks or ETFs. I've got a few that I've wish listed. I don't have the tickers memorized at all. But silver's something that I've been big on because gold is great. Gold is a fantastic hedge. But again, a newer investor like myself, gold has such a high barrier to entry just because it's so expensive per ounce. But silver, I think silver, this sounds like the worst cliche in the world, but I don't know how else to put it. Silver is going to be the new gold because it's still a hedge, it's still a precious metal, but it's a lot more affordable to get in with it. So yeah, 2 years from now, I could see myself taking that drip and mostly throwing it at the big indexes for that long-term hold, as well as, again, man, I'm stumbling here just all of a sudden. But again, it's the silver and the precious metals. But things are flexible. I mean, I may get to a point 2 years from now. It seems like it's close, but it's a long time. Who knows how the world changes? You do have to be flexible and adapt. I may decide I need a little bit more income. I may get to that $1,500 a month mark quicker than I would have expected. In which case, maybe I just decide, okay, I still want to play out the 2 years, but now my revised goal is $2,000 or $2,500 a month. We'll see. Basically, I'm giving myself a couple years to get there, but the tentative plan is large indexes and a lot of silver and precious metals dripping once I get there. So, and what's going to be nice, what's going to be nice is at that level, I don't necessarily need to put in my own money every month because I'll have enough to drip that even if I forget about investing for a month, which I won't, it'll be like, oh, yeah, I've got my $1,500. Let's drip this. Let's reinvest this. And I like the idea that my money will have made myself so much money through distributions by that point. By the way, at the 2-year mark, most of these ETFs, if they continue to perform relatively similar as they are right now, they'll have paid off their principal as well. And that's important to me as well, is to get to a point where the distributions pay off the underlier. And then at that point, it's just pure profit. So
I have a question for you about timeline. You threw the number 2 years around quite a bit. A lot of investors would say, Matt, 2 years is a long time. How do you remain so steady on the investment gun for 2 years without, I want to say batting an eye? And I think this is something a lot of investors, should, for their own personal selves, become more comfortable with, is having that time in the market to just breathe and relax. But yeah, you throw it around quite comfortably, right? Oh, 2 years, 2 years will go by. It's a long enough time. It will also go by pretty quickly. From my experience, time flies. But for many out there, that's not the case. They're looking to get rich by Tuesday. What would you say to them?
Okay, so I would have a two-part answer on this. To start, about 2 years being a long time, I'm already at this point 8 months in. And so I've already done a quarter of that time frame. Now, in addition to that, I'm seeing more success than I had at my initial goal. I've doubled my initial goal for income by 8 months in. So to be quite honest, it's pretty easy at this point, knowing that I'm already a quarter way there and had more success than I planned. It's pretty easy to keep going. Now, one thing I want to say, and I'm not going to get into specifics, but my trading account is not my only investments. I have some investments, like a mutual fund through my bank. It doesn't perform very well, but I've been investing in it for a long time, just dripping a little bit. I thought it was important to have some sort of investment, whether or not I was in the market. I also have a lot of very valuable collectibles. I was a 90s kid. I collected, all these Pokemon cards, kept them in good shape, threw them in a binder in my storage locker, and I've recently found out apparently those are one of the most profitable hard goods that you could have kept. And I've got these Pokemon I was looking up, $400 here, $200 there, shadowless, doubled the value on a bunch of these things. So I got that hidden away. And, I've speculated, this is where my true geeky side, if it doesn't already show behind me with the artwork, is going to show. I collected rare and sealed video games, and I use an app to chart what I've got. And I'm not going to say specifics, but it's about double my trading fund is how much those collectibles are worth. So this is why I'm relaxed. I've got a good job. I've got a stable job. Like I said, I'm still with the company that I found out of university. I've been with them like 13 years at this point, I think it is. So stable job, other investments besides the trading, my trading account, and the fact that just my trading account is blowing out my goals so far. And I'm a quarter done. So in a nutshell, that's why I sleep soundly at night doing this.
Now, because you already made the heap of mistakes that I even hate to call them mistakes because they're really just lessons. But do you think that they were necessary for you, and do you think they are necessary for other investors to go through? in order for each individual investor to really learn their lessons and get on the track, the way that they are supposed to, or the way that makes them feel comfortable. Like so many of us will jump on and say like, oh, I wish I didn't do this. I wish I didn't do that. And, understanding wisdom, it's like somebody can watch these videos, read all the books, but yet they still make the mistakes, the classic mistakes. So why do we do that? Why do you think that is?
Oh, that's a great question there, because you're speaking to one of my other loves, which is psychology. I mean, that's why I took my degree into it. Do people need to make mistakes, and why do we need to make mistakes? A lot of us have egos. I mean, if you're looking for a why, and I think I had that myself, I would like to say, and I try to be as humble a person as I can, but early on there was a measure of arrogance in my investing. When I got that first $1,500, increase in that very first stock in 7 days, yeah, there were some thoughts that went across my head. Like I used the term shooting fish in a barrel. Oh, this is going to be so easy. Why didn't I do this? I'm going to be a millionaire in like 5 years. Those types of terrible thoughts did cross my mind. And so ego is there. I think the wisest investor would realize that through education, they can minimize their mistakes, but they're still going to have a few mistakes. I think it would be safe to say there's billions of retail investors, and there's also the big corporate investors. Like, the market is a huge dynamic pool. It's emotional, just because what is invested in the market at the end of the day, it's people. People are invested in the market because we're throwing our resources there that we care about. People get emotional. They buy the wrong stock. They panic at Liberation Day. I knew a guy who panicked on Liberation Day. I told him, please don't do this. He sold his entire portfolio at like the worst part of the Liberation Day dip. This guy, I'm not going to mention where I know him from or anything like that, but he just wiped out his own portfolio. He was a newer investor, and he just got scared. He got scared that things were going to go down. It was going to be like, the stock market crash of 1929 or whatever. And that's actually one of the hardest things as a newer investor to do, Ari, is I think control your emotions. There's definitely a lesson there, because you're going to make mistakes. And okay, if you need to take some time off like I did for your own emotional health, do it. But you do have to pick yourself back up, dust yourself off, and get back in there. So try to always analyze the mistake. Try to figure out the root cause if there was any. In the case of Peloton, I can't blame myself for what happened with their equipment, but I can blame myself, the lesson there being, don't buy when something's high. I knew it was super high. I would not have bought it if I didn't think it was going to get bought out by a bigger company and that I could get like a quick 20% premium on my shares. But I knew I was buying high otherwise, and that was unwise. And now I've learned from that. And I have not bought a stock since that has not been on some sort of a dip. So there's an example of a lesson.
First and foremost, seems like you did all that research to learn. And so what were some of the most helpful, avenues of learning? If there was books, what books did you read? How did you know what YouTubers to trust? And the other part of this question I want to ask you is, once you came back around to investing, which it seems like you got into the ETFs, but I'm sure you even looked at some individual stocks when you were getting back in the game. How did you know, or what metrics to look at, or what metrics did you deem and still deem today the metrics that are your go-to?
That's an interesting question, and the two parts of that. So I should answer the first part about how I found out my information. A lot of it, like the vast majority, was honestly YouTube. And what it was, it started with my best friend. He's not really an investor, but he had done quite well with ETFs. And I had visited him, and he had just done well with ETFs. Just again, those large index ETFs, and he had been investing in them for a long time. So that was the first time where I actually considered what are these ETFs. Now, my portfolio, it's all ETFs. And it's because I had to learn about them what they did. And again, they offered diversification, which based off my story, I had zero diversification at the start, or close to zero. And I love the idea that these exchange traded funds could be traded like a stock, but they would give you that diversification in most cases. And, I'm a believer too in like I said, balance. Slow and steady wins the race. It appealed more to me to get into funds that grew slowly and more reliably than it would be stocks and just try to, sell them when they skyrocket and buy them when they're on a terrible dip. To be honest, I don't have the time in my day to do that kind of trading and to be able to react super quick. I tried to keep a close eye on Liberation Day because that could have been a huge, financial issue for me. But in the normal day, I don't have the ability the time because I've got a full-time job and I'm just busy living life to just trade individual stocks, really. So it's kind of the appeal. I know you mentioned, what individual stocks did you look at? My case was more going from individual stocks into ETFs, at least for this 2-year near term, as I call it, see what it can do, see how it grows. And then it's more of a case where we would talk individual stocks. And again, I would fall back onto precious metals mostly. I'm not a huge tech guy, actually, for my portfolio. I've studied the heck out of the dot-com crash, and I remember living through that. I wasn't invested, but I was a teenager, and I just remember all these adults around me, teachers, parents, being afraid what happened with all their tech stocks that crashed. And I just see, like, AI is very useful, but if you've looked up videos and graphs, the AI bubble, it mirrors the dot-com bubble so closely that it's terrifying. So yeah, and the tech stocks are the ones that really make you money. They're the ones that can get you those huge returns, but I'm just too scared to touch them at this point. Might touch them in a couple years, but we'll see.
So are there any ETF metrics that you look into, or how do you know which ETFs to add to your portfolio once you came back around to rebuilding it?
Great question, but I can't give a data-driven answer. I can give an answer, but it's qualitative, not quantitative. But it's great that you asked that question because I think you need to trust the people that are running these funds. So they are as important to the fundamentals as any website could give you with graphs on what their fund has done so far. So when I started to invest in NEOS or T-SPY or any of these funds, J with Alti, I purposefully looked up interviews with those gentlemen, both YouTube and in print, because at the end of the day, it's those guys, and thank goodness they come to YouTube to speak to retail investors. That's great marketing on their end, but it also gives someone like myself the chance to, for lack of a better term, meet the person who's going to be managing my funds, managing my money. Because like I'm kind of a warm, humanistic sort of guy, I would like to think. So I care about the person behind the fund, not just the data. So, the NEOS guys, Troy, I forget his partner's name, but I saw one interview. Troy does, I think, most of the interviews. They just seem like good Gen X technocrat guys. They were just always into finance. They don't seem, especially arrogant. Jay is a great talker. Jay is someone that just gets you so excited about, his funds. Cy with T-SPY just seems like a younger guy, but seems like he's really got his head screwed on well with what he wants to do with his fund. And yeah, so metrics for me, my metrics are going to be seeing how are these funds going to perform over the next few years, of course. But it's important for me before I invest in any fund that I look into who's managing it. And that is something that I would say is good advice for pretty much anyone, if you're investing in anything, is find who's behind that fund. If it's an ETF or if it's an individual stock, I would encourage you to look up some interviews with the CEO or the management team. See, do these people come off as slimy, like they're holding something back? I hate, the cliched term used car salesman. Do they come off like that, or do they come off like a low-key person that just wants to grow a good business or a good fund, and you can trust them with your money?
Now let's go on the flip side of that question. Is there anything that you sometimes see when you're evaluating an ETF that's a red flag that you feel even other investors, whether they're newer or more experienced, should stray away from?
Yeah, red flag. Well, to be quite honest, one of the biggest red flags that I've told some people in my personal life have heard how successful I've been in a short amount of time. So I've helped some other people build similar portfolios just because they tell me, like, hey, I really want to build a similar portfolio to yours. And one of the things I tell them to look out for is when it's a new ETF, I think you got to give it 6 months to season. I've heard that term once or twice. ETFs just, they tend to go haywire. They can go up, they can go down. But it really seems, if you look at the graphs from their inception, it takes what is their true valuation about 6 months to steady. So a red flag, honestly, for me, would be a brand new ETF. There's several that come on the market that I hear about every couple weeks, and they get me really excited. But they're new, so I put them on a watch list because I am not comfortable in investing in them until they have that 6 months to season. Another red flag, and I'll be honest, I'm seeing this in Alti after the recent jobs report dip that it took. I understand that these covered calls and these funds, NAV erosion is always a concern for people, but I'm not concerned about capped gains, but I am concerned that these funds can either stick with their baseline level, or if they dip, can they recover? It doesn't matter to me how quick that recovery is, but it does matter that it happens. And after we had the Liberation Day crush, honestly, most of my ETFs performed very well in recovering. I didn't have Alti at that time, but I had Alti for the recent August jobs market report that caused a dip in the American stock market. And Alti, yeah, it only went from like $6.23 to like $6.02. But it has not recovered from there. And that makes me nervous. I don't need it to go to $10. I don't need it to go to $7, but I do need it to go back to that 6. I need it to recover a little bit, and it's not. And so that would be a red flag for me is erosion with no bounce back.
Now, speaking of erosion, you can go the more traditional route of, income producing products, if you will, in the market, which would be your traditional dividend stocks. I'm just curious to know, did you ever look into dividend stocks? And if you did, why didn't you go in that direction? And if you didn't, why not even go in that direction? Because they do provide stability over the long course of time. They don't have the NAV erosion. And for the most part, while they're not producing, 10%, 12, 15% yields, they're steady.
Yeah, I considered that. Now, one of the reasons some people will tell you they get into income investing, and this is part of the reason, a minor reason I'm into it myself, is the ability to plan. So Alti's weekly, the rest of my holdings are monthly. That really helps me plan my investing. It helps me project. I had a number of dividend generating stocks on watch lists. In fact, I owned a few for some time. Like Disney actually had a dividend. I owned Enbridge. I had a couple K actually in Enbridge last year, which was a pretty good dividend stock, but it produced with much less yield than my ETFs do. But as well, that was a 3-month. When it would distribute, it was every 3 months it would give a dividend. That just really didn't help me plan. There wasn't a lot of reward in that as well. It was kind of like, oh, ding. Oh, I guess Enbridge paid out. Yay. Whereas this monthly engine that I've got going on, it seems like it's the perfect amount of time for me to consider what are my next steps. Feed it back into a spreadsheet, an Excel spreadsheet, to see how I think this will grow by the end of December, by this time next year. Just having those reliable monthly distributions for me really helps me plan, and that gives me more, as you would call it, comfortability with my portfolio.
Now, I've asked a lot of investors this very question. I want to ask you for your opinion, but because of what we're now seeing these days, with first of all, the amount of ETFs overtaking the amount of individual stocks, but not only that, these very ETFs are producing the 10+% yields that are giving a lot of investors predictability and sustainability over time. Is the traditional route of dividend investing dead and gone, or is this more of a trend of what we're seeing right now of this giddy up in ETFs?
Great question, Ari. So I think there's some things we need to consider. The ETFs that I've invested in, these are, I would call, second or third generation ETFs, even amongst ETFs that generated income. I mean, it was great to have those pioneering ETFs when they started, but honestly, a lot of them have not performed very well over the long term. But I think as ETFs as a classification of security have started to mature, you've seen a lot more interesting strategies like what Neos does and Sai with T-Spy, with his, I guess, I forget what they're called, like zero time calls, same day calls. It's just very interesting strategies. And I do think they're helping to address some of the problems that those early generation ETFs had. And with that improved performance, as long as they can show that performance over time, meaning, the next 5-10 years, I really do think that this is the wave of the future for income investors. I just think you'll just progressively have, you can call it quiet quitting, just traditional dividend-based income investors just, sell their holdings and enter into ETFs, because by that point, these newer funds are going to have proven, hopefully, their value. The growth community that hates them, they say, well, they're never going to survive, a big crisis. I would say Liberation Day was a pretty big crisis. They would probably say back to me, well, it was 1 week. And I go, well, but it was a heck of a week. Like, that was a major dip, and these funds recovered well. So maybe it's going to take a larger correction, a 6-month, 1-year correction, and these funds are still able to maintain good distributions and climb their way back up to hopefully their original value before the crash. If that happens, that might be a tipping point where these funds, I know they're already successful, but where they get even more successful as traditional income investors flip over to ETFs.
Now, Matt, let's say you had the opportunity to whisper into the ears of your younger self. I want to wrap up just by asking you, what exactly would you whisper into that younger Matt's ears to set him up for success today?
I would warn myself. I mean, it's hard because the easy answer is I would just go back in time and give myself the strategy that I have right now and just say, don't bother with those mistakes. But it goes back to your earlier question. Did the mistakes prompt me to become the more educated investor that I am today? They probably did. I think if there was one warning I would give myself would be regarding emotions. Just don't get scared. It was great I had my friend that I could run to like a scared little puppy every time the market was down for a few consecutive days and say, hey, are we okay? Is the sky actually falling here? To which case he'd always say, no, these are tiny little bumps in the market. I tell myself to be less emotional, to have more emotional control. As far as like general advice without getting more specific, like don't buy this specific thing, it would be emotional control. And I would probably just tell myself, like, you just hold on until these certain covered calls, these certain funds start coming out. Don't even call them a covered call, just the third generation of ETFs, because I would tell myself some amazing financial strategies are coming. Maybe throw my money into just blue chips for a few years that had a decent dividend and then do this strategy. But I would have definitely told myself to wait until these funds came available and then pounce on them.
Matt, I hope to have you back on Masters of the Market maybe in 6 months at the end of the year or heading into 2026 just to see where you're at and to keep tabs on this portfolio that you're building, because it is building very rapidly and you are at the beginning of this journey. But I want to take a moment here just to say thank you to you for joining me on Masters of the Market and all of us, and for all the investors out there. Of course, until the next go round of Masters of the Market, we will catch you all in the next one.